Hey everyone, welcome. It's great to see you again. It is Thursday, July 9th. I cannot believe how fast this week has gone by. I mean, all the weeks fly by, right? I know there's still one more day, but still, this is just crazy how quickly these days go by. When I do this live stream every day, it's like we're here already. It's 4:30. It just, the day goes by so fast. I happen to think one of the reasons, I think one of the reasons why the day goes by so fast is because I look forward so much to doing these live streams. I love it, and I appreciate you coming for the ride. Thank you so much. You're watching a new live stream. This is a show that is called Be the Boss of Your Money. The theme here is I want you to be the boss of your money, not you to be bossed by your money. So I want you to be the boss of your money, not your money to be the boss of you. So we're going to roll the introduction, but just a couple of quick things I really want to point out. The people are talking about the CARES Act that we had, $2 trillion stimulus, and the House of Representatives, the House passed a $3 trillion bill called, the HEROES Act, and everybody's talking about stimulus. What are we getting? And it's become like a pretty important topic, because now that the number of coronavirus cases are surging, people are really thinking again that they may need more help. So let's get into this. We're going to roll the intro, and then we're going to talk about all this, and it's going to be a really informative, good episode today. So here we go. All right, you're watching Be the Boss of Your Money with Mitch Goldberg. That's me, by the way. Thank you. If you have any questions, please ask away in the comments. If you're watching this in the live stream, I'm here. If you're watching this in the replay, ask away as if you were watching this in the replay. We've got some really good things to cover here. I want to talk to you about stimulus if we need it. I think the bigger issue than more stimulus from Congress is the fact that we need it. Like, why? I mean, things were supposed to improve, and they were starting to improve. The states were reopening, and now we're seeing that the number of COVID-19 positives are surging. Florida is now considered the COVID-19 epicenter of the world. Texas is not far behind. And we've got more COVID-19 positives now than ever in this country. And a number of hospital systems are basically overwhelmed in a couple of states, again, in Florida and Georgia. And, there's still no national policy on this. There's still no agreement on how things could reopen. It's basically reopen now or not. It's getting harder and harder to find anything in between. So let's just get into this. We'll dive right in. Anyone who watches the show knows we always start with a quick review of the day's action. Every day has a theme. And more important than just giving you an update, you can get a market update anywhere. I add perspective. Listen, I've been doing this now full time for over 30 years. So I add some perspective, some commentary, hopefully a couple of good jokes in there once in a while. I think my jokes are funny, but hey, if you don't think they're funny, then you know what? Screw you, okay? No, I'm kidding. You see, you can say these things on a live stream. You can't say them on cable TV. You can't say them on network, but you could say them on a live stream. But I'm just kidding. I'm so glad you're here, and you could say whatever you darn well please. Okay, so let's do a quick share screen. We're going to get into a couple of quick updates, and boom, here we go. You see, Dow is off 361 points, down 1.39%. The S&P was only off about 0.56%, down 17 points. Why was the Dow down so much? Basically because Walgreens, which is a component of the Dow, just got absolutely smacked today. So Walgreens stock was the key determinant. Now, Boeing didn't do so great today either. So the S&P off a little bit. But plus the S&P has a lot of the NASDAQ stocks. So you see the NASDAQ was the lone index that was up today, up 0.5%. Because, the same large cap tech and communications companies keep leading the way. You know who they are. We talk about this like every single day. Nasdaq set a new record, of course, new record high. So, but the S&P has a lot of these big cap, tech stocks that have been going up. So the S&P is able to hold up a little bit better. If you see the Nasdaq up, then that'll typically help the S&P. Because they have a lot of overlap, the S&P 500 and the Nasdaq. Russell 2000 was off 2%. That's a pretty big hit. If the Dow is down 2%, we'd really be, talking about that a lot. If the S&P was down 2%, that would be a big deal. People don't really look at the Russell 2000, the Russell 2K, down 28.48 points. That's the small cap index. It's companies that are more domestic oriented, very subject to the domestic economy. And when you see that doing poorly, tells you the feeling about the overall economy, that the phases of the reopenings are slowing or stopping. That's not new news. Hospital systems are becoming overwhelmed in various states. It's not new news. The number of deaths are climbing. Sadly, not new news. Very sadly. So, the phases have stopped. A lot of school districts, I think most school districts in the United States start school in about 6 weeks or so. 6 weeks is not really a lot of time to try to bend the curve. So the big debate now is, well, do we, send the kids back to school and give them, give the school districts proper procedures to mitigate the spread of COVID-19, because we can't stay like this forever. And the other side of the argument is, let's just wait until we really can bend the curve before we go back. Like the curve in some states, like New York, it's been bent positively. The curve in a lot of other states, in particular the Sunbelt states, has been bent, but in a very negative way. So look, I don't know. I mean, every parent has to decide for themselves if they want to send their children to school or not. Now, the latest news from World Health Organization is that for a good amount of people who get COVID, they get brain damage and central nerve damage that could be permanent. Really scary thing. But I know some of you are out there. I see Andrew is out there. Well, let me just take your question now. You think EVs are in a bubble territory? What about biotechs with potential vaccines? That's a great question, Andrew, and I'm going to give you the answer. But I want to give it to you in a little while. Okay, sorry, but just have to get through the update, and then we're going to talk about that. But I'll put that back on the screen in a couple of minutes. Okay, so the VIX was up a little bit, up 4%. That's typical, though. And the major averages go down, like the S&P, the VIX goes up, and it's always an exaggerated amount. The VIX will move 3, 4, 5% on a small move in the S&P 500. But traders get a little bit nervous. The VIX is still under 30, barely, but still under 30. And it's one thing to be nervous about the economy. It's another thing to be nervous about your FANG stocks. So let's just take a quick look at the FANG stocks. FANG is Facebook, Apple, Amazon, Netflix, Google, and Microsoft. Okay. It's these stocks that basically determine the market. So once again, Facebook is up, Apple, Amazon is up Amazon's up $101 a share. After everything that's been said and done, Amazon is up another $100 a share. Just hit 3,000 for the first time on Monday. Netflix up a little bit. Alphabet, that's Google, up 1%. Microsoft up 0.7%. So as these stocks go, as goes the Nasdaq for sure, and they help pull the S&P 500 up. And let's just take a look at some divergence here. The tech stocks, these are the sector ETFs. There's 11 sectors of the economy, and there's an ETF for each sector. I'm going by the Spiders S&P Depository Receipts. These are just ETFs that are very popular, well-known. They've been around for a long time, and there's one for each sector of the economy. So tech and communications in the lead. Keep in mind, XLC, that's the communications ETF. Facebook and Alphabet, they make up 50% of that ETF. I mean, if you have two stocks, they make up 50% of an ETF. Why even bother having an ETF? Because you're just not really getting the diversification from it. Diversification is a strategy that we use to mitigate risk. Doesn't necessarily protect your portfolio from going down in a generally down market, but it does help protect a little bit from blowing up on one particular stock or sector or ETF. It's not a strategy to maximize gains, just to help reduce risk. Okay. Real estate was off and everything else, but look at the bottom performers: energy, industrials, financials. I'm like, ugh, these are screaming, L-shaped recovery. We always talk about a shape, like a V shape is swish down in the stock market and the economy, and a swish up, we come right out of it. We're talking about a V shape a couple of weeks ago. Not anymore. Now it's more like L shape, where we just kind of go down and stay down, except for a handful of large, cap tech stocks, software, social media, communications, and semiconductors. All right. And last thing I'm going to show you in this particular update here is this. I don't know if you can see this, but the top one is the XLK, the ETF we just looked at for technology. It's up 17% year to date. And the lower number, this is year to date, the lower number, -2%. That's the S&P 500. That's an index. You can't invest directly into an index. I don't know if you know that. You could invest in a security like an ETF or mutual fund that tracks or mimics an index. There is a difference. Okay. Anyway, the S&P down 2%. So you're talking about a 19% spread. That is a really, really big spread right there. Okay. And it just goes to show you the outperformance of a handful of stocks are pulling, the 17% of these stocks are in the S&P 500. If you took the tech and communication stocks out of the S&P 500, you'd probably, this is just a rough off the top of my head guess, but you'd probably see the S&P 500, 40% lower than where it is now. That's a lot. I mean, think about that. That is a big number. In my mind, it's 40%. Maybe it's more, maybe it's less. But because what happens is then you're just relying on companies like airlines and cruise lines and, the industrials of the world, the financials of the world. And these stocks have all just gotten hit so freaking hard. Okay. So let's stop the screen now. Stop sharing screens. I want to talk to you about the Stimulus Act. The next Stimulus Act coming up. And I see you out there, Jeff, and I'm going to get to you also. The last Stimulus Act we had was the CARES Act, CARES, $2 trillion plan. It gave it's so far doled out about $269 billion of stimulus checks to people who make $75,000 and under $150,000 for people who file jointly, something like $135,000 for a head of household. Those numbers, you get a little bit, you could still get some stimulus money if you make a little bit more than that, but it gets phased out as you make more. So if an individual makes $99,000, they make nothing. If you make, let's say, 85 or 90,000, you get a little something. Okay. But the House of Representatives, which is dominated by Democrats, said, let's do another Stimulus Act. And they said $3 trillion, $1 trillion to help all the states. It's kind of like a once and for all gigantic stimulus package. Give it out. Let's stop with this doling money out a little bit at a time. We know we're going to eventually do it all, so let's just get it out of the way. That's how I think of it. In my mind, that's what the House of Representatives is saying with the HEROES Act, and they want to give up to $1,200 per person, including $1,200 per child. So a family of 5 could get $6,000. That's even more generous than before, because minors were getting up to I think $500. Adults up to $1,200. And but Mnuchin's been out, and Senator McConnell's been out, and they've said it's the next Stimulus Act is not going to be as generous as the one before. I saw yesterday something like 80% of people who were getting unemployment with that extra federal aid, $600 a week, were making more money unemployed than they were when they were working. So Mnuchin, Secretary of the Treasury Mnuchin, came out and said he's like the main negotiator for the White House with Congress, and they're working very closely with the Republican-controlled Senate. And what Mnuchin and what McConnell are saying is you were thinking more like $1 trillion stimulus, and stimulus checks limited up to $40,000 as opposed to 75,000 in adjusted gross income. So a lot fewer people would get the stimulus checks. A lot fewer, families would get a lot less, or a lot fewer families would get the stimulus. So that's one thing. They also said, and this is kind of crazy. They said, we're not giving that money out to states because we don't want to reward states for being, spendthrifts, not good at managing their money, which is kind of crazy because if you think about it, yes, there are a lot of states that were not good at budgeting and finance with massive budget gaps. Illinois is the poster child for that. New York ain't so great either, guys, but the coronavirus, it just blew everything apart. So, but they don't want to give money to states that are spendthrifts. But there are a lot of blue states as well as red states. So it's kind of like how do you determine this? I mean, if states need the money, they need the money. Technically, a state can't go bankrupt. Okay. I think it's actually against the law for a state to go bankrupt. The government, central government, would have to bail them out. Just politics. So the other thing is, that's really and the Heroes Act wants to give money to first responders. They really want to dole out a lot of money. And the Republicans' idea, the Senate idea, is going to be more like, we're not giving out such money. And the last thing is that people should not be earning more than 100% of what they were making before they lost their job. So it's going to be a substantially less generous package than what people were making before. So we call that the income cliff. End of this month is the income cliff. It's also the end of the moratorium on evictions for renters and foreclosures. So people are starting to worry, well, if the economy was coming back, we wouldn't have to worry so much about it. But now with more shutdowns, United Continental Airlines said they're getting ready to lay off 36,000 people. And that's happening all over the place. Restaurants are having to shut down again, or they can't even open. So it looks like the economy is going into not a full shutdown like it was before, but it's basically a switch. The states that were shut are staying open. The states that stayed open or reopened too quickly are going to close again. And that's the worry. All right. So that's the difference. When will this come out? Congress went on their July 4th holiday recess. They won't be back until something like the 20th or 21st of this month. And then they've got about 10 days until their summer recess. So we might not even get anything until September, which means people might not even get any stimulus money until September or October. At the earliest, it'll be September, but it could be pushed till October, maybe even November. It's really tough because we've got the election coming up. President Trump has said he favors much bigger checks, a lot more largesse than even the CARES Act. I could see why. Listen, it's an election. You want to give, make people's lives easier. Hey, I'll throw you another $1,200. Don't forget to give your boy a holla for the next vote. Hey, there you go. So I could see how that's going to go. Okay, so let me just get out to Andrew's question. EVs are in a bubble. Look, when you say EVs, you have to be talking, or at least I have to be talking about Tesla. Now, Tesla's up like 40% or more maybe in the last couple of weeks. Is it in a bubble? Look, I think bubble is the most overused word there is in the financial world. But I do think in general, I'm just going to point out in general, the Amazons, the FANG, the Tesla, the Salesforce.coms, the companies I'm talking about. I think the divergence between how much these stocks have gone up compared to the rest of the market is one thing. Okay. So I think too much, and I don't know if I would call it a bubble, but they have good things backing them up, though. It's just not enough, I think. Listen, whenever their valuation always makes sense in the moment to the buyers, to the owners. If you own a Tesla, if you own an Amazon, you believe that they are well valued, they could go higher. You believe it. That's why you own them in the first place, because you believe it. but they've got growing businesses, margins, all these great things. Stay at home, work from home. Amazon's the classic stock for that. Tesla makes great a product that you want, not just that you need. So but you can always justify valuation. Valuation, though, is a timing tool, is a pretty lousy track record. Overvalued and undervalued conditions can stay that way for a long time. The smaller companies, I'm not really sure who the smaller EV companies are. I'm actually not familiar with any of them, unless you want to say maybe Ford or GM, because they're, on a market cap basis, they're a lot smaller than Tesla. But I think alternative energy, not I think I know, alternative energy, wind energy, solar, those stocks, they're basically correlated. They're not non-correlated. They're correlated with the price of oil. Most people think it's the opposite. But when oil goes up, oil becomes expensive, gasoline becomes expensive, alternative energy stocks go up because people think, and everybody's going to want alternative energy. So you're not really getting diversification, just so when you buy alternative energy stocks and energy stocks in terms of price movement. I know it sounds crazy, but the correlation is very strong. All right, so I don't know the smaller companies, though, in EVs. Jeff is out there. Hey, Jeff, good to see you, my man. Post-update query. Is the Dow or the NASDAQ a true measure of the economy as it relates to people, i.e. people are better off or not, or is it just a measure of the investment community? It is just a measurement of the investment community. It is not a measurement of the economy. Listen, if the stock market reflected the true economy, we'd be, I think, a lot lower. The market, though, is doing what it should be doing. Now, in some perverse way, it's in some perverse way. If you actually had a vaccine for COVID-19 tomorrow, worked, everybody's happy, everybody get back to work. We've got hundreds of millions of vials for everybody, for the whole world, billions of vials. I actually think that would send these FANG stocks lower, because now it kind of blows apart that whole work from home trend that we're in. I'm not saying people are, I'm not saying that there's some permanence to working from home and a lot more people can telecommute and remote work and all that. But by and large, most people will get back to normal then if it comes out pretty quick. So that's one thing. The S&P 500 is a large cap index, and it's just basically telling you how large cap stocks do. Now, companies do reflect fundamentals in the economy and all that. And the S&P 500 is actually doing exactly what it's supposed to be doing. Investors are doing what they're supposed to be doing. The market's working. The stock market is supposed to help investors pick winners and losers. It's capitalism, right? And, if you look at the airline stocks, they've plunged. Financials, they've taken a big hit. Industrials, way the heck down. The stock market is separating winners from losers, as opposed to just, everything in the S&P, every stock in the S&P going up or down together, like risk on, risk off. The stock market has picked winners and losers. So it's doing exactly what it should be doing. This situation with the virus, it's like, custom made for the largest tech and communication stocks. So they do well. Are they too high? My own opinion is, if I had new money coming in, it would be really tough to buy these, and I'm more of a profit taker in these than a buyer, but a little bit, nothing crazy. I'm not an all-in or all-out guy, but if you have huge gains in these, and these things have become a bigger proportion of a client's portfolio than originally planned for, it's a personal finance decision, and that's a reason to take some off the table. And that's happened with a bunch of accounts where these stocks have just literally crowded out the other stocks. What am I buying though? Instead of when I sell, if I sell these stocks, I'm not really buying anything right now. Cash is king. If something is sold at the moment, mostly it just goes into cash, and that's okay, because cash levels, have gotten a little low, and I want to build those back up. And I think it's important to do it now while the getting is good, as opposed to try to do it in a rush when the getting ain't so good. All right. That's my story. I'm sticking with it. By the way, shout out to John Pasqua. Thank you very much, buddy, for watching. Hey, Judy. You usually give me a heart. What's with the like button? You mad at me? I took the garbage out last night. Okay. Change that to a heart. All right. I'll speak to you guys Monday. You know, I stopped doing the live streams on Fridays because in the nice weather, nobody's watching. And, you know, I need to give myself a break. 4 days a week is enough for this. It's a lot. I will go back to doing these on Fridays in the fall, but I do send out every Friday a blast email that is really, if I may say so myself, it's phenomenal. It's totally original, very unique. And if you'd like to receive that, you know, just let me know in the comments or send me a DM. I'll get your email address. I'll sign you up, and you'll get the blast email. Okay. I'll speak to you soon. This is Mitch Goldberg signing off. See you next week.